Qualifying ratios are numbers that lenders use to see if a borrower can pay back a loan. Two common ratios are debt-to-income (DTI) and loan-to-value (LTV). Both DTI and LTV are used by lenders to assess the borrower's risk level and determine if they are a good candidate for the loan. The actual requirements may vary based on a lender and loan program. It is essential for first-time buyers to carefully consider their DTI and LTV ratios before applying for a loan and ensure they have a solid plan in place to make their monthly payments. A high DTI may make it more difficult to qualify for a loan or limit the amount of money they can borrow. Debt-to-income ratio, DTI, is a measure of the borrower's monthly debt payments relative to their monthly income. It is calculated by dividing the borrower's total monthly debt payments, including their new loan payment, by their gross monthly income. The result is expressed as a percentage. A high DTI indicates that a borrower has a lot of debt relative to their income, which may make it difficult for them to make their loan payments. Lenders usually want a borrower's DTI to be below 43%, but this can change based on a loan and lender. Loan-to-value ratio, LTV, is a measure of the size of the loan relative to the value of the asset being financed, usually a property. LTV is a measure of the size of the loan. It is calculated by dividing the loan amount by the appraised value of the property or the purchase price, whichever is lower. The result is expressed as a percentage. A high LTV indicates that a borrower is borrowing a large percentage of the value of the property, which may make it riskier for the lender if the borrower defaults on the loan. Lenders generally prefer a borrower's LTV to be below 80%, although this can vary depending on the loan program and the lender's requirements. A higher LTV may result in a borrower having to pay private mortgage insurance (PMI), which is an additional cost to protect the lender if the borrower defaults on the loan. Private mortgage insurance (PMI) is a type of insurance that protects lenders in case a borrower defaults on their mortgage loan. PMI is typically required by lenders when a borrower makes a down payment of less than 20% of the home's purchase price. PMI helps lenders reduce their risk by providing a safety net in case the borrower defaults on the loan. It's important to note that PMI is not the same as homeowner's insurance, which protects the homeowner in case of damage to the property. Homeowner's insurance is a separate insurance policy that is also typically required by lenders when a borrower takes out a mortgage loan. Sublenders may be willing to lend to borrowers with higher DTI or LTV ratios, but they may also charge higher interest rates or require additional collateral to mitigate the risk.